Hello and welcome. You have tuned into ET Now. I am Jayesh Khilnani, and over the next 30 minutes, we have a special show with a very special guest that will help us in coping with the sell-off. Quick introduction about the guest that we have joining us today, Raoul Pal, CEO and co-founder at Real Vision. Well, he started off as a sales executive before moving on to Goldman Sachs and heading that European hedge fund business. Later on in 2014, he founded Real Vision. But first, let me set the context of the conversation today and give you a backdrop of how the world looks like in terms of the financial markets. Of course, first up, we have the declining global trends along with the impending concern of the US-China trade war. And we have also seen that the US yield curve, that has been inverted, which has definitely preceded the recession in history. And lastly, we have the dollar index, which is currently trading at about a 2-year high. Given this context, Raoul, first question to you is that what makes you nervous about the market and why do you think that things are about to collapse?
I deal in probabilities and not certainties. So I'm looking at the probability, an increasing probability that we're going to enter a difficult period. That's based on a number of things. Firstly, it's US and global economic growth. As we know, we're seeing economic growth everywhere on the decline. Many nations around the world are already in recession. The US looks like it is following suit. My belief is it is going into recession that was caused by the Federal Reserve over-tightening rates a year or so ago. So I think that is the issue. The trade tariffs came on top of that, and also the Chinese slowdown. And that put together has created a really big problem for the global backdrop. And we've even seen it with India slowing down as well. It's kind of pervasive and broad spread now. Now, the question is does it fall into something that can get more complex and difficult? Well, it probably does. And the bond market is telling us that, particularly in Europe and the US, where bond yields have been falling so sharply. It's extraordinary, and kind of screaming that recession is the big risk. That's okay, and we understand that, and the Federal Reserve are slowly cutting rates, but my view is they probably won't do enough. I think there is an issue with the US dollar, that there is a shortage of dollars offshore, and that is driving emerging market currencies down and other currencies down versus the US dollar. The most spectacular of all has been the break of the Chinese RMB against the US dollar at that 7 level. And that is driven by this dollar shortage. And we're about to enter a period from September, October, November, where we're going to start taking out even more dollars from the system. And there's a complicated part of the financial plumbing of the system where the US Treasury is going to issue a lot more bills, a lot more debt to start replenishing their savings account that they spent when the debt ceiling was in place. And that would be that, plus the extra spending means that the government has to raise something like 600 billion of new capital from the markets. And that will be a 600 billion tightening of money coming out of the financial markets. And the problem is there's not enough dollars around globally to deal with that. So I think we've got a structural problem in a cyclical slowdown. And we have this catalyst out there as well. So that's why I'm really nervous.
Well, Raoul, we will definitely touch upon some of the key aspects that you just mentioned. But before that, I just want to highlight the inverted yield curve that we have and historically how it has in fact preceded a recession. If we can have that yield curve on the chart, you'll see that, every time the difference between the 10-year and the 2-year yield, that in fact dips below zero. There it is. The yellow line shows you the inverted yield curve, which currently you can see it has dipped below the zero mark. And historically, you can see in the last couple of decades, there have been 3 instances where the yield curve has in fact dipped below zero. And post that, we've had these red patches, which is actually the recession. So Raoul, next question to you is that firstly, do you see this as a preceding indicator? Do you see that there could be a recession coming ahead? And what are some of the indicators that you're watching out for?
Well, I've seen it coming for some time. So it has been my core thesis since about March of 2018 when I started to see China slow down dramatically. Then we had the trade tariffs come in, and then we started to see somewhat of a US slowdown in the bond market yields started falling dramatically. We've started then, the next part of the cycle you would see is the rate cutting cycle, and we've just started with that. We've only had 25 basis points from the US, but the bond market is pricing in a lot more. I have a fear that the Federal Reserve are not reading the situation well enough and that they might underperform. If they do that, then they're likely to ignite the dollar again and ignite the bond market again, and maybe even see more inversion of the curve. Now, what I am expecting is us to go into recession globally, because I don't see anything to counteract this. Even if there is no more escalation in the trade tariffs, there's more tariffs to come. And most corporates around the world are having to look at their global supply chains and make adjustments because they can't trust the US government's stance with regards to where certain nations lie in terms of, favorability or not. Can they manufacture in India or not? Can they manufacture in Mexico or not? We don't know. So if you're a corporation, you are not going to make investment decisions. So I think that is recessionary globally, and I don't think we've seen all of that start to flow through yet. So if I look at capital expenditure, we're seeing it's falling globally. If I look at the PMI surveys globally, many are in recession. In fact, the global PMI, the world PMI, is below 50, which would suggest that the world is headed towards recession. We're seeing the US ISM fall below 50, which increases the probability of recession significantly. We're seeing Germany in recession. We're seeing China essentially in recession. We're seeing manufacturing contract everywhere. We're seeing global trade contract everywhere. Everybody, all major countries are seeing global exports and imports decreasing. We're seeing big ticket items decreasing as well. So there's a lot of leading indicators that suggest that there are trouble ahead. I use the LIBOR, which is the London Interbank Offered Rate, the kind of global price of money in US dollars. I look at the 2-year and 2-year rate of change, and it suggests that things are going to get worse in the business cycle into at least mid next year. And it's not clear any better than that. So I think any optimism we're seeing in the markets currently is probably misplaced. And again, I don't deal in certainties, I deal in probabilities, but the balance of evidence suggests that we should continue to see a slowdown, and the majority of US data will prove that out over time.
Right, Rahul. There's another interesting chart that I want to highlight before getting to the next question. If we can have that on the screen, it shows you essentially the relationship between how the dollar index has moved vis-a-vis emerging market equities. And there you have it. The blue line is the dollar index, and you can see that in the last couple of years it has inched gradually upwards, while the MSCI emerging market index, which is the red line, that has seen a steady decline. So far this year we've had a 5% plus decline. Also, Raoul, in your September note, you have mentioned that you are extremely tempted to short emerging market equities. Can you highlight some of the reasons why is that so, and particular emerging markets that you're looking to short?
Sure. So the emerging markets, generally 80% of all of the performance of emerging markets is explained by the weakness or strength of the US dollar. When the US dollar is strong, emerging markets do badly, which is why most emerging markets have not done well over the last few years as the dollar's been strong. When the dollar is weak, emerging markets tend to do well. Then within that, obviously, different countries have different cycles and different strengths and etc. So the one that worries me the most, I would say, would be South Korea. I think South Korea is getting caught up in the global trade situation. They're already within a trade dispute with Japan, one of its largest trading parties. We've got China, which is the largest trade counterpart of South Korea, slowing down dramatically. There's a reasonable amount of debt within South Korea as well. And so that makes me worry that the South Korean currency is going to weaken significantly, and that would see the stock market fall as well. I think India may fall into that zone. I am structurally, long-term, a very big India bull, but I worry that there is a little too much exposure to India still, and that there is some disappointment in the economic cycle, and that I'd rather own India from a cheaper place than I would now. although I'm not actively looking to short India. I never bet against my structural view. My structural view is much longer term bull.
Raoul, this brings me to the next important question. What is your view currently on Indian equities? Have you had the chance to look at any of the key index charts that we have, namely the Nifty or the Nifty Bank, or any other sectors that you've looked at?
Yes, I mean, look, I've been very long for a period of time, and I closed out most of my longs about 8 months, 9 months ago when I started getting concerned about the bigger picture. I was long the banks, the telcos, and the Nifty overall. I still think that, as I said, longer term they're okay, but short term, you can see the price action is much choppier and complex, and it just feels like that there is a rotation. You know, I think the Indian government bond market offers great returns in comparison to equities right now, and much more surety. So you can see that kind of rotation going on. I think that's the right thing to happen for India. I don't really have any chart patterns that I'm aiming for within India, but I do know that I think bond yields fall significantly over time.
So in that case, do you believe that India comes out ahead of other emerging markets in case and when the tide turns?
Well, for that to happen, you need a weak dollar. And I don't think that is going to happen anytime soon. I think if the balance of probabilities and the balance of risk to me is a much higher dollar. And if we have a much higher dollar, that's a really big problem, not only for India, but for all of the other emerging markets. So I fear that that event is to come first. So there could be more downside. Now, India, as we know, is not a massive net exporter nation overall, and it's a relatively closed economy. So I think India does somewhat better, although India needs access to the global capital market. So there will be some drawback from that, but maybe the rupee does relatively good versus other emerging market currencies. But after that, because of the young population, the dynamic business growth, all of the opportunities that lie within India, the digitization of the Indian economy, I think there's just enormous structural opportunities within India that aren't going away for 10 or 20 years.
Well, that's very encouraging to know that you have a positive view on Indian equities as well. But one important factor which actually impacts Indian equities is, of course, the crude prices. And we have seen that we have been in a bear market. Crude is down about 30% from its 52-week high that we've had. What we can see on this chart is a long-term chart in the last 5 years. The blue line indicates the prices of WTI, whereas the red lines indicate the upper boundary or the upper trend line and the lower trend line. We are at a very interesting position. Raoul, lower the prices for crude is beneficial for India, and I believe that you are also bearish on crude. In fact, your research notes suggest that you have a $20 per barrel target for crude oil prices.
Yes, I think that's right. It is. We're in the most positive seasonality for oil now, so it's bouncing around a little bit. There's always news out of Iran, always news out of OPEC. But if you think of the story that I've been telling you, the narrative that I think is in the markets, explained by the charts, it's one of deflationary and global demand destruction. And if that's the case, we should see it in copper and we should see it in oil. Copper broke a big head and shoulders top and looks to be suggesting there's further downside. And oil looks like it's formed some sort of wedge pattern that would allow for a fall down to somewhere around $45, which would be a larger support level and a neckline of a much bigger head and shoulders top. If that breaks, which I think it will, because it would be consistent with the dollar charts and all the other charts, then I think oil could go to $30 or if not $20 a barrel, which I don't think people are prepared for. I think people think the status quo is the most likely. Again, if you're thinking in Indian terms, that's pretty constructive for India to have one of its largest import costs reduced so dramatically. So that would be a stabilizing effect.
Well, we'll certainly watch out for those levels on crude oil prices. But let's take a step back and discuss equities once again. And I believe that you are of the view that there is massive weakness in global equities. So let's start with what your view is on the US market. If you've had a look at the charts, what are the long and the short-term charts suggesting for maybe the S&P 500 or the Dow Jones?
So short term, it's not clear, probably some further upside. But if I look at the relationship of equities against the business cycle, and we can use the ISM or something like the ECRI as a cycle that's readily available, it shouldn't have much further upside. And certainly into October, it should start to exhibit some downside pressure. The longer term picture, I think it's relatively bearish. I don't think there is a great opportunity in the equity market here. But my focus has been much more on bonds and currencies than equities, because equities are difficult. As you're seeing that bifurcation of some things doing well, some things not doing well. And that kind of period reminds me of the top pattern that we saw in 2000, 2001, or 2007, 2008. So that makes me nervous of equities, but I don't want to be short here and I don't really want to be long either.
So Raoul, next question is on the mid-cap space. How are you viewing the entire mid-cap space in the US market? Do you have a reading on the Russell 2000?
Yeah, the Russell 2000 is really underperforming, as is the Dow Jones Transport. And they look like they're telling us that the broader market is topping out, versus those leaders within the S&P 500 that tend to be focused in a few technology companies. So if I look at that relative chart of the Russell versus the S&P 500, it feels like it's forming a large head and shoulders top pattern, which again is the kind of topping pattern we've seen at other market tops, where the internals start falling away, leaving very few leaders.
Raoul, let's also get your view on the interest rate scenario. Do you believe there is a big collapse coming in ahead for the US 10-year or the 2-year? And what sort of levels are you watching out for, respectively, for the 10 and the 2-year?
The US is the outlier in terms of where its rates are. Australia was the next highest rates. I think both Australia and the US go to zero. I think they have to. I think you have to have some equalized rates. If not, you've got a big problem with the dollar being so strong. So I think US rates need to get to zero. I think the 10-year bond, if I'm seeing the same, that deflationary trend that I'm seeing in those big picture charts, and I look at the long-term downtrend in US 10-year yields, well, it looks clear to me that they're going to zero, and arguably they might go to negative 1% or further. If I look at the long-term yield curve, the long-term 2-year yields of the US, and I put a regression analysis on it as well, it suggests there's a possibility of negative 4%. Again, it's not a prediction, but what I'm saying is so many people are looking for rates to increase based on a pickup in the cycle. When I look at the balance of probabilities and the largest black swan, it's for yields to absolutely collapse below anybody's expectations. And I think that is where the money can be made if you're looking at betting on outcomes that have outsized risk rewards. It's not betting on interest rates backing up a little bit or falling a little bit. It's looking at, is there a potential that US does what Europe does and Europe gets worse as well and it drives the whole thing further? I think there is a relatively high probability of that.
Well, the trade of the year definitely has been the long dollar and the long gold trade. But do you believe there is more upside to any of these asset classes?
Yeah, I think the trade of the year has actually been long dollars, long gold, and long bonds. So those three together have been highly correlated, an extremely good trade and very high quality returns, i.e. volatility adjusted returns have been great. The dollar and gold, I do think they continue for an extended period of time. Sure, gold is going to have to correct. I think if the dollar does explode a bit higher in a sharp move, the dollar will correct somewhat. But we've got to understand what gold is telling us. It's telling us that it's normally inverted to the dollar because it's priced in dollars, but it's going up at the same time. And the reason being is it's telling us that it knows that as the dollar goes higher and global rates fall lower, there is a higher probability of an extreme outcome from the global central banks, whether it's Japan having a debt jubilee or Europe going to more extreme stimulus or the US eventually going to massive fiscal stimulus. So gold is acting like an option on monetary largesse from the central banks on an unprecedented scale. And my view has been for some time that both the dollar and gold continue to rally, and eventually at a point much higher than this, the dollar peaks out and gold is kind of the last man standing. And I think that's a structural thing that we're going to see play out over time, if I'm right in my view.
So Raoul, is saying that the dollar has more strength, more upside left. But what does that mean for emerging market currencies?
Well, don't forget, the emerging market currencies are priced against US dollars. So what you would see is the price of emerging market currencies go lower. But more importantly, you would see the fact that many emerging market countries need and have dollar debts. And the problem is your dollar debts suddenly go up because the dollar's gone up. So you have to pay back more debts. So that becomes really complicated. China has the biggest problem in the world with that, with many trillions of US dollars in debt in US dollars. So the problem is every time the dollar goes higher, it becomes harder to pay back the debt. It means that suddenly that pushes more people to try and pay back any debts. It drives the dollar even higher and creates this feedback loop that is really complicated. When the dollar goes higher and there's dollar funding crisis, then you find that emerging markets tend not to do as well. So I think it means that the equity markets would see downside, and we would also see downside in the currencies. And as I said, that ADXY index of Asian currencies would suggest that the downside is actually much larger than most people expect.
Well, Raoul, one final question to you on Bitcoin. Now, in the recent note, you have also mentioned that this is probably the last chance to get on board the rocket ship of Bitcoin. Why is that so? And do you believe that we could see all-time high levels very soon?
My favorite investments have been, as we said, dollars, gold, bonds, and Bitcoin. And Bitcoin's had a good start. It's been consolidating in a nice kind of wedge pattern, and I think it breaks higher than here. Why? Because it, like gold, acts like an option on potential larger issues within central banks as central banks get to the end of their abilities to control the economy via rates. And so therefore Bitcoin has a value against protecting yourself against things that can happen to your own currency and your purchasing power, much like gold does. It is becoming a rapidly accepted way of thinking of these kind of things, and also is potentially an option on a future financial system. Blockchain technology, along with Bitcoin itself, has a lot of very advantageous things to it that are seeing mass adoption. Additionally, we're about to see the supply of Bitcoin next year halve. It's called the halving. It happens every few years as the algorithm that calculates Bitcoin makes it more difficult to mine Bitcoin. Now, the more difficult to mine something is, the more the price goes up. And I think that is proven out over time to be a core part of Bitcoin and its pricing value. So I think it plays an important part and will play an increasingly important part of the global financial economy.
Well, thank you, Raoul, for taking the time out and an extremely insightful conversation that you've had with us on ET Now.